following is a paid program. The opinions expressed are not necessarily those of WNBU and Interbanks Media. Welcome to All Things Money with David Blain, a thoughtful and revealing discussion of actionable ideas and effective strategies to help you through the complex world of investing, taxes, and real estate. Now, with All Things Money, here's David Blain.
Hello and welcome to All Things Money. I'm your host for the show, David Blain. We thank you for joining us today on 94.1 FM WNBU and cable TV 10 in New Bern. We've got Bob Register on the board there making the show work across all sorts of platforms, TV, radio, and we're also on the internet. A lot of you may be either streaming the video or downloading the MP3 to your iPod. We welcome you as well. Last week, for those of you that didn't hear, last week we closed on an acquisition, my firm D.L. Blain Company, which is now known as BlueSky Wealth Advisors. We changed the name to reflect our global or our national presence. We're not global yet. We got a few international clients, but our national presence, we have clients now in about 17 states across the country. We just acquired the business of Pleasanton Financial Advisors in Pleasanton, California. I know a lot of those people are going to start tuning in on the internet. Probably won't be able to get 94.1 all the way across the country or cable TV 10, but they'll certainly be listening in over the internet. So we welcome all them out in Pleasanton. It's in the East Bay area, kind of north of Silicon Valley, east of San Francisco, for those of you that aren't familiar with it. Just a wonderful place. Another firm out there committed to fee-only comprehensive planning and investment management. The owners were just retiring, and it was just a great opportunity for me and my firm to step in. They got a number of employees out there that'll be staying and helping manage those clients out there. So it's just a great opportunity for everyone involved. In today's environment, I was talking to some doctors the other day, and they said, you know, in medicine, you can either need to stay really small, like a sole practitioner, or you need to get really big. Well, it's kind of the same thing in the investment industry, that the growing number of regulations and burdens imposed by the Dodd-Frank bill, the SEC, all sorts of things, trying to retain and attract good employees, benefits and things like that. You need to stay really, really small, or you need to get some sort of scale behind you to be able to afford it. And so that's the decision we made to make sure that our firm is there for people well into the future. We need to ensure our own financial stability, our own ability to continue to prosper through the years. We advise our clients all the time to diversify their investments. Well, the same thing in business is we wanted to diversify geographically. We wanted to diversify, get some more personnel involved so that we have a nice, stable platform for all our clients. No concerns about one person leaving, or if the markets drop, or the Eastern North Carolina goes into recession. We'll still be strong. We'll still be able to continue to do what we do best, which is help our clients achieve their own long-term goals. So anyway, we're excited about that. And once again, we welcome everyone out there in California who may be tuning into the show now. Okay, I wanted to start off today with a story about the Dow. A lot of people, when they look at their investment accounts, they're comparing it to one benchmark or another, and they watch TV and they see, oh, the Dow went up 2% today, or oh, the Dow lost 500 points, or those type of things. The S&P 500, different indexes. And although it is a reasonable proposition to occasionally review your portfolio versus some benchmark, the selection of the benchmark is very critical, that you make sure you understand what you're looking at. And I personally always discourage people from looking at the Dow. First of all, the Dow is only 30 companies. The Dow is also what's called price weighted, meaning that a company whose stock price is $200 has more impact on the return of the Dow than a company who, say, share price is $20. And that really makes no sense. They should either be equal weighted, or as in the case of the S&P 500 and most indexes, they're capitalization weighted, meaning that Apple, which is the most valuable company in America right now, or maybe it's Exxon, they're kind of in trading places recently, but your Apple, your Exxon, your Microsoft, your Google, those are weighted more heavily in the index, not because the price of the company is more, but because the price times the number of shares, the aggregate dollar volume of shares available in that particular company is the highest. That's called market capitalization. Well, the Dow, as was started in the 1800s, is price weighted, which it may be a little too technical, but it makes no sense to me and a lot of other people. The other thing to keep in mind with these indexes, even the S&P 500, there are committees that decide which companies go in the indexes and out of the indexes. We would prefer that people compare their portfolio to a more broad-based index, such as the Wilshire 5000, which looks at the 5,000 largest companies in America, which encompasses about 98 or 99% of the market capitalization of all the companies. So with the Dow, you have 30 companies. They're selected by individuals. And what I wanted to point out is, as of today, the committee that sets the companies announced that they're going to drop Alcoa, Hewlett-Packard, and Bank of America. They're going to drop them from the Dow next week. And it's a pretty big shakeup. There's only 30 companies in the index. So that's 10% of the index is being changed in 1 week. Alcoa, which has been in the Dow for 54 years, is going to be replaced by Nike. Payment company Visa is going to replace Hewlett-Packard. And Goldman Sachs is going to replace Bank of America, which only spent 5 years in the index. HP joined the index in 1997. And the changes are going to take place on September 20th. And one of the reasons cited for the replacement was the declining share price of the companies. And so the Dow committee is engaging in a subtle form of momentum trading or market timing, or whatever you want to say, is that they said, well, the share prices have gone down a lot, so we're going to take them out of the index. I mean, it's almost a subtle way of saying, well, we want to artificially keep the returns of the Dow index high. It's just something that I don't like to see. And when you're comparing your portfolio to an index, we want a broad index with thousands of companies that doesn't require human intervention to say, well, this company's going in, this company's going out. For some particular motive. Like I say, because the price went down on these 3 companies, they're taking them out. And Bank of America was only in there for 5 years. And the index committee also said they wanted to diversify the sector and industry group representation a little bit. So the S&P Dow Jones indices are owned by McGraw-Hill Financial and Dow Jones Company made these changes. Well, we're coming up to the end of the first segment. When we come back, I'll continue talking just a little bit more about indexes and which ones may be appropriate to compare your portfolio to. So for All Things Money, I'm your host, David Blain, and we'll be right back.